Is the AI boom creating a once-in-a-generation growth story for the world's most important chipmaker? Or is the unprecedented spending a sign of a bubble waiting to burst? Taiwan Semiconductor has been on a tear, with its stock price hitting new highs. This week, the company's financial updates and strategic moves have given investors plenty to think about. So, was this a breakout week or a sign of risks to come? Welcome to TickerWatch News for Taiwan Semiconductor, Week 8, 2026. This is the weekly podcast that breaks down the essential news and developments for Taiwan Semiconductor Manufacturing Company. Let's look at what moved the stock this week. It was another strong week for Taiwan Semiconductor. The stock closed Friday's session at $370.54, marking a weekly gain of roughly 5%. This performance significantly outpaced the broader market. In the last trading session alone, the stock's 2.8% gain easily beat the S&P 500's rise of about 0.7%. Over the past month, the company's shares are up more than 10%, standing in sharp contrast to the broader computer and technology sector, which saw a loss of over 3% in the same period. The quick takeaway is clear. Investor confidence in the chipmaker is running high, with the stock showing strength that leaves the overall market and its direct sector peers behind. This week's bullish sentiment was fueled by several major developments. First, the company's financial engine is firing on all cylinders, driven by insatiable AI demand. Taiwan Semiconductor reported that its January revenue surged nearly 37% compared to the previous year, setting a record for the month. Looking ahead, the company is boosting its capital expenditure plans for 2026 to between $52 and $56 billion, a huge jump from 2025. This massive investment is intended to expand capacity for its most advanced chips, as the company now projects revenue growth of around 30% for the full year. Second, the company is making major moves to diversify its manufacturing footprint. It was announced that Taiwan Semiconductor's second plant in Japan will produce advanced 3-nanometer chips. This is an upgrade from previous plans and is a significant development for Japan's goal of re-establishing its own semiconductor industry. This move helps address geopolitical risks by reducing the company's manufacturing concentration in Taiwan. And third, the geopolitical landscape continues to evolve with a new trade deal between the United States and Taiwan. The agreement lowers U.S. tariffs on Taiwanese goods to 15%, a move directly linked to Taiwan Semiconductor's commitment to invest heavily in its new fabrication plants in Arizona. While the company is expanding its U.S. presence, Taiwanese officials have also stated that moving 40% of its manufacturing capacity to America would be impossible, highlighting the delicate balance the company must strike between global expansion and its home base. These headlines reinforce Taiwan Semiconductor's critical position as the picks and shovels supplier in the AI gold rush, benefiting no matter which chip designer comes out on top. Wall Street has reacted to this stream of positive news with overwhelming enthusiasm. Multiple analysts updated their outlooks this week. D.A. Davidson initiated coverage with a buy rating and a $450 price target, citing the company's durable, self-reinforcing advantage in leading-edge manufacturing. Bank of America reiterated its own buy rating with a $470 price target. Other firms, including Morgan Stanley and Barclays, also raised their targets. The company currently holds a Zacks rank of 1, indicating a strong buy. The narrative among institutional investors is just as bullish. Recent filings show that prominent investors like Stanley Druckenmiller and Ray Dalio have been adding to their positions in the company. This overwhelmingly positive sentiment from both analysts and major funds aligns perfectly with the stock's recent price action, as shares continue to climb on the belief that Taiwan Semiconductor is a core beneficiary of the AI infrastructure build-out. From a technical standpoint, the stock is in a strong uptrend, trading near its all-time highs around the $370 mark. The consistent upward momentum over the past year suggests strong buying pressure. On the fundamental side, the company's valuation remains a key topic of discussion. Despite the significant rally, its forward price-to-earnings ratio stands at about 25. Many analysts consider this valuation reasonable, if not attractive, given its growth prospects. Projections for 2026 suggest revenue growth of nearly 30%, with earnings per share growing even faster. The central narrative is one of growth, fueled by the AI boom. However, this is balanced against risks. These include the enormous capital spending required for global expansion, which could pressure margins, and the persistent geopolitical tensions surrounding Taiwan. While some investors worry about a potential AI bubble, the current consensus is that the demand from major technology companies is real and sustainable for now. Looking ahead, investors will be monitoring several key areas. First, any follow-up data on chip demand, like the company's upcoming February sales figures, will be watched closely to see if the powerful momentum from January continues. Progress reports on the new fabrication plants in both Japan and Arizona will be critical, as successful and timely execution of these multi-billion-dollar projects is essential. Perhaps the most immediate catalyst to watch will be earnings reports from key customers. NVIDIA is scheduled to report on February 25th, and its results and guidance will provide a crucial signal about near-term demand for the advanced AI chips that Taiwan Semiconductor manufactures. For now, the bull case rests on continued execution and booming AI demand. A bear case would involve an unexpected drop in spending from cloud providers or an escalation in geopolitical tensions. The most likely scenario is continued growth, though with the volatility that comes with operating at the center of the global technology and political stage. Thank you for tuning in to TickerWatch. Please remember, this podcast is for educational purposes only and is not financial advice. Be sure to subscribe, leave a review, and share this episode. We'll be back next week with another look at the news moving the markets.